Hey, Money Vikings, welcome back. This is a little bit of a Sunday roundup. Wanted to check in on a couple of the big themes of the week in terms of investing and building wealth and all that kind of stuff, and do a little bit of recap of some of the stuff we talked about last week. One of the things I wanted to mention was check out our video about ways to think about risk by Howard Marks out of Oak Tree Capital. I find his talks about risk very interesting. The bottom line sort of lesson that I get from it is that we have to think about risk. We can manage risk outcomes via probability, but you cannot avoid risk. And there's also a couple of tropes out there that we've realized are not true. So one of them is the more risk, the more reward. That is not true. A lot of times, the more risk, the more loss. So keep that in mind when you're investing. Now, on the flip side of that coin, it does not mean that we don't take risk. And it does not mean that, going into low risk, quote unquote, investments is the way to go all the time. For me personally, I take what he says in terms of building thoughtful, strategic, resilient portfolios. And you know that I tend to talk a lot about that. I like to talk about types of portfolios. To think about portfolio construction is very important, I think, for wealth building. For me personally, because that's what I share on this channel, that is about portfolios that have a variety of asset classes and exposure to different types of assets. Some of them correlated, some not correlated. But a lot of times, actually, you can't even predict what will and will not be correlated or uncorrelated. Certain things that used to be uncorrelated or we thought were uncorrelated are actually correlated. Bitcoin comes to mind with that. And again, not saying Bitcoin's a bad investment. I do a little bit of that. It's not my favorite because of quote unquote risk. But it used to be that we would think that when inflation was high or when tech stocks or other stocks tanked, that Bitcoin would go up. Well, it hasn't really played out that way. So anyway, that's the first thing. Think about risk. Think about portfolio construction. Next thing I wanted to mention was just happy fall to everyone. So we're starting to head into a different season, pumpkin spice season. It's Jerry's favorite time of year. I'm kidding because Jerry does not like pumpkin spice, but I like to kid him about that. So what comes with that every 4 years is a political silly season. So it has been shown time and again that we should not be making investing decisions based on politics. We should stick to resilient, all-weather, all-time portfolios that make sense in a variety of diversified, strong, strategic assets. And, politics kind of just pendulum swings. It goes back and forth in this country. I'm not saying there aren't consequences to that. Of course, it means something. So the biggest thing is to get out and vote. But the other thing, though, to do is don't fall into having this total fear if your candidates don't win. Our system is pretty resilient because it's got separation of powers, and you have lots of tiers of government and lots of different interests that are sort of debating and jockeying at all times. And, hopefully in the end, they're balancing each other out. A lot of the ideas of things like how our Senate was built and set up was to be sort of a shock absorber for the full-throated kind of aggressiveness of our House of Representatives. And then, of course, the executive is managing how things are managed from a macro level. So anyway, for me personally, I don't do a lot of investing decisions based on politics, if at all, because I have witnessed people that have done that, and they have time and time again lost. They will have some stereotypical trope or cartoonish image of a party or a candidate, and they'll think that, the minute that this happens, the whole system's going to this, and then I'm out, or I'm getting out, and I'm getting, whatever their thing is, all I'm doing is holding gold. And I've never seen that work really that well. So maybe this time it's different. But probably not. Probably not different. Okay. A big thing on my mind, I'm going to talk about this next week in some of our videos, is how to invest when things just seem so high. Real estate seems high, even though it's come down a bit. you know, the S&P 500 in general, the Dow Jones, they seem high. You know, we're in this interesting situation where next week we're going to, I believe next week, is it next week? I'll have to check that out. Anyway, pretty soon we're going to hear about interest rates probably being cut by the Fed. The effect on the market, I don't know what that's going to do. Is it already baked in? Is it neutral? Is it going to go down? Is it going to go up? We don't really know. But in general, inflation is cooling down. It continues that cooling trend. I think we're all starting to feel that a little bit. I'm not saying anything is inexpensive. Doesn't feel that way to me. But it does feel like inflation's cooling. And I believe we're starting to see some of that. Still some things high. But, you know, it seems to be trending the right way. That's what we can hope. Of course, you do want some inflation. Inflation means that the economy is growing and chugging along. So, you know, some level of inflation, I think the Fed targets around 2%, around there, 2 plus or minus 0.5, whatever it might be. That can be, I believe, healthy for a growing economy as time goes on. So I think we're about at that rate. That's at least what it seems in terms of the way inflation is going. So, okay, those are just some thoughts. Please leave some comments. I'd like to know what you think about investing right now and how you're positioning your portfolio for the future in terms of feeling that things are high. Do we care? Does it matter? If you have a diversified portfolio of assets and things go down a bit, that's fine. You're going to be dollar cost averaging and buying more shares at a lower price if it does go down. And as I talk about quite a bit, there's never a magical day, at least in my book, where I'm going to be selling everything. That's not the point. The point is to create passive income machines and draw off a small amount of income off of a portfolio in the future. And so do I care if, you know, do you care if one day something's worth $1 million and then a couple weeks later it's worth 800,000 if you're just holding it and you're going to build income off of it? I don't really know if it matters that much. The biggest issue is you don't want to be a forced seller at the bottom of anything. That's the biggest cardinal sin in my book. And think about that for a minute. So you don't want to be a forced seller at the bottom of whatever it might be. So because you've lost a ton of value, you've cashed out, and you've lost a bunch of your initial capital. So that's something to keep in mind. So anyway, please share your thoughts, and happy fall as we head into that season, and talk with you all soon. Thanks for watching.